Welcome to The Explainer. The yen carry trade is often described way too simply. Borrow cheap yen, buy something with a higher yield, collect the cash, right? Well, that textbook version totally misses the terrifying systemic reality. Today, we're unpacking the real macro plumbing. The yen carry trade is not just an FX trade. It's a massive balance sheet mechanism that feeds liquidity into global equities, credit, emerging markets, and sometimes even crypto. When Japanese rates stay low and volatility remains contained, this financing channel behaves exactly like a global risk asset faucet. But when those conditions reverse, the unwind spills over into global financial conditions. In this deep dive, we're going to uncover what the carry trade actually is, why it became the world's favorite funding currency, how the Bank of Japan changes the math, and what a real global faucet shutoff warning actually looks like. So here is our roadmap for today. We'll be defining what the carry trade actually is, exploring why it became the world's favorite funding currency, reviewing historical carry trade crises, analyzing the global liquidity faucet, laying out practical frameworks and red flags, and wrapping up with a final summary. Section 1. Defining the carry trade. Let's start right at the beginning. Many describe it as simply borrowing yen to buy foreign assets. And that is directionally right, but it's really incomplete. The absolute fastest way to get an intuition for this is this simple idea. It's a leveraged short yen balance sheet used to finance higher return assets somewhere else. And that somewhere else, it could be US Treasuries, corporate credit, emerging market bonds, equities, or macro relative value trades. It's literally any asset that looks attractive relative to the cost of borrowing yen. Let's walk through this systemic chain sequence. First up, the funding leg. Borrowing yen cheaply sets your baseline. Next is the currency leg, where selling that yen creates your short exposure. Then you have the asset leg, where you're chasing those higher yields, and the magic ingredient here, the leverage leg. It makes the trade highly profitable, but, and this is a big but, incredibly fragile. If you only think of this as short JPY, long USD, you completely miss the real point. If you remember one single thing from our explainer today, make it this. The yen carry trade is a leveraged cross-currency position that turns cheap yen funding into massive global demand for non-yen assets. It's essentially shadow liquidity. It is how global investors create extra risk-taking capacity without that liquidity ever showing up as a normal bank loan. The tricky part? The trade looks deceptively easy because the risks are perfectly hidden during the good times. People see a stable yield differential, but they completely miss the brutal reality of sudden FX crashes. They see deep markets, completely forgetting that liquidity practically vanishes the second everyone runs for the exact same exit. The core trap here is that carry trades are dangerous because their pain is totally nonlinear. You can make modest gains for months and literally lose it all in an afternoon if the funding currency rallies or volatility jumps. It constantly looks smarter than it really is, right up until the moment it becomes crowded and unstable. Section 2. The world's favorite funding currency. So why did the yen become the absolute favorite? Well, it definitely wasn't by accident. It happened because Japan supplied a very unusual combination of conditions for a very long time. Look at these structural ingredients. It wasn't just about low nominal rates. It was the fact that the low-rate accommodative policy lasted for an entire generation. That allowed massive pools of capital to build complex, synthetic plumbing right on top of it. With deep domestic savings and incredibly robust FX derivatives markets, synthetic borrowing became highly practical. It simply became a global habit deeply embedded in portfolio construction. Now, here is where it gets incredibly interesting. A massive share of this exposure is completely invisible in textbook data. It's built synthetically through FX swaps and forwards. And even when the Bank of Japan started to normalize, the yen didn't instantly stop being a funding currency. You see, funding currencies lose their dominance when the entire regime changes, when hedging becomes too expensive, and investors actually start to fear yen appreciation. That transition is exactly why we need to think in terms of faucet pressure, not just a simple on-off switch. And that brings us to a crucial rule. Bank of Japan normalization only really matters when it becomes a sequence. Looking at this timeline, the BOJ didn't just break the ultra-easy regime once in March 2024. By setting up purchase reduction plans and extending further hikes into 2025 and 2026, they turned a one-off move into a persistent, visible tightening regime. The fundamental math of the trade began to permanently shift, signaling to the market that funding was no longer going to be nearly free. But hey, Even looking out to 2026, there is still a positive policy rate spread of roughly 275 to 300 basis points between the US and Japan. So the conclusion isn't that the carry trade is dead, it's just that the faucet is less open than it used to be. Positions built for a near-zero yen world suddenly require a whole lot more scrutiny. Section 3. Historical carry trade crises. Let's look at history, because it absolutely matters here. The exact same pattern repeats. The trade looks perfectly benign during calm periods, right up until leverage and volatility violently collide. Take 1998, with the Russian crisis and the collapse of long-term capital management triggering a massive global rush to safety. The unwinding of huge, highly leveraged exposures drove wild swings in the yen. The core lesson? Investors don't actually need to change their view on Japan. They buy back yen simply because they're bleeding money somewhere else and need the liquidity. Then, of course, there's 2008. During the global financial crisis, the carry trade broke for a much deeper reason. The whole system shifted. Volatility surged, and funding conditions tightened abruptly. The important takeaway from 2008 is that carry trades don't just fail because central banks change rates. They fail when funding liquidity tightens, market liquidity deteriorates, and the willingness to run leveraged cross-border positions completely collapses. Which brings us to August 2024, a spectacular, sudden unwind. After some hawkish central bank meetings and a weak U.S. jobs report, leveraged positions came under immense pressure. The yen appreciated, equities sold off, and the VIX spiked. The BIS estimated carry exposure was at least $250 billion going into this, and frankly, due to data gaps, the true number was likely much larger. August 2024 taught us that a yen-funded channel can choke global markets literally overnight, even without a banking crisis. Markets stabilized quickly, but it brilliantly exposed the hidden plumbing to everyone paying attention. Section 4. The global liquidity faucet. So why exactly does it behave like a global liquidity faucet? Because in many ways, it acts just like a shadow central bank. It's not a formal lending facility, but when conditions are right, it absolutely behaves like one. When the faucet is wide open, meaning funding is cheap, the yen is weak, and cross-asset volatility is practically zero, it supports massive purchases of foreign bonds and allows hedge funds to crank up their gross exposure. What's truly fascinating is how this spills over into the United States and beyond. Easier financial conditions from Japan literally lubricate U.S. markets, tightening spreads in risk assets globally. The trade affects the entire world's ability to hold risk. But when that faucet starts closing, everything changes. The danger isn't just the dollar-yen exchange rate going down. The real, terrifying risk is that one funding channel gets tight, and suddenly multiple global risk books lose their life support at the exact same time. When we look at what does not count versus what actually matters, a real shutoff warning isn't just one BOJ hike, one short covering rally, or one scary chart on social media. I mean, those happen all the time. A real warning happens in distinct stages. Early on, the BOJ starts sequential hikes, and the yen stops failing on rallies. Then comes the confirmation phase, fast yen strength, and a sudden spike in cross-asset volatility. Finally, late-stage stress hits. You start seeing margin pressure, prime broker stress, and completely unrelated global assets selling off together as the ecosystem violently unwinds. The most important concept here is that the real danger hits when the baseline assumptions that made cheap yen leverage feel safe all break at once. Section 5. Frameworks and red flags. If you want to track yen carry risk seriously, you need a full dashboard, not just a single chart. Let's look at the frameworks. You have to monitor a sequence of indicators here. You're watching the Bank of Japan's policy path and the Fed BOJ rate gap to see if the basic math still holds up. You're watching yen crosses and implied volatility to gauge leverage stress. Finally, you have to watch high beta assets and prime broker positioning. If those riskier assets are underperforming even on good news, and margin stress suddenly appears, the alarm bells should be ringing loudly. The key principle to remember isn't whether the trade is on or off. The real question is this leverage becoming mechanically impossible to hold? Now, there are a few massive mistakes investors fall into here. Don't treat this as a pure FX trade, and don't only stare at the BOJ. The Federal Reserve matters just as much. Also, remember that a single unwind or bounce back doesn't mean it's over. This trade can survive warning shots. And most importantly, do not ignore the derivatives plumbing. The real danger is almost always hidden off balance sheet, and the worst pain often strikes because investors are bleeding in completely unrelated portfolios and are just forced to sell. Section 6, the final summary.
To bring this all together, the yen carry trade is not just some neat little trick for harvesting interest rate spreads. It is a massive global financing mechanism. It turns cheap Japanese funding into demand for non-yen assets, fueled by leverage that rarely shows up in standard, clean balance sheet data. That is exactly why it behaves like a global liquidity faucet.
So what turns an ordinary macro development into a real shutoff warning? Well, when the faucet is open, risk assets feel better funded, volatility feels manageable, and investors boldly push their gross exposure further. But when it starts closing, the problem doesn't stay in FX. It spreads viciously into equities, volatility, and global financial conditions. The right framework isn't panicking at every single headline. It's watching for a true regime shift, higher cross-asset volatility, weaker performance in crowded trades, and forced de-risking. That combination is exactly what turns an ordinary macro development into a real shutoff warning.